We are finally finishing topic 7, which we started way back in December. This video will be useful as a review as you prepare for the test, and it will also add a bit of new information that you'll be responsible for also on the test coming up. Excuse me. So let's take a look at the screen. We've been talking about methods of calculating the cost of goods sold and the valuation of inventory for a retail store. And the last part's important. We're talking about retail businesses, businesses that buy merchandise already packaged and assembled and put together, then sell it at a higher price to customers. And we'll talk about a different kind of business in a few minutes, but this is the kind of we've been talking about in the recent problems, retail stores. We talked about 3 different ways of evaluating inventory. And the key to all of this is the fact that when we sell an item off our shelves in our store, that amount of money that we get for that item is not profit. We have to understand how much we paid for that originally and subtract it. That gives us something called gross profit. Businesses have different ways of doing that because it becomes more and more complicated the bigger the store, certainly. So the 3 kinds we looked at were first in, first out, last in, first out, and average cost. So we'll go through some examples just to be sure that you're clear on how all of this works. First of all, some information. We will assume that this store has a monthly accounting period, and during the month of January, they bought inventory 3 different times. So the store buys 50 items of inventory for cash, let's say, at $100 each, and that totals $5,000. A week later, they buy 60 items of inventory, same kind of inventory, same supplier, but the cost went up to $125. So that purchase of inventory cost the store $7,500. On the 21st then, another 40 items were purchased, again for cash, this time even higher at $130 each, totaling $5,200. So the total amount bought during this accounting period, the month of January, is $17,700, and the store bought 150 items. Then we made apparently just one sale on the 25th. 30 items were sold for cash at $150. They were marked up to $150 each, and we received $4,500 in cash. So that's the information, and that kind of information will be put into the journal and then the ledger. And I want to look at some selected accounts in the ledger to be sure we understand how this works. On those 3 dates, the 7th, the 14th, and 21st, inventory was debited, would have been debited in the journal, now posted to the ledger of these 3 amounts, totaling, as we said, $17,700. Cash is credited each time. These were cash purchases, so cash goes down with the credit. Then on the 25th, we made a sale. We gained $4,500 in cash. That's a debit, and sales would be credited by $4,500. So again, we sold 30 items. We received $4,500. So realistically, we don't have $17,700 in inventory anymore. We need to make an adjustment. So we use one of 3 methods to do that. We'll look at, first of all, the first in, first out. And as you know, that simply means we will assume, and it's an assumption, we will assume that inventory is priced as the cost of our items that were bought first. So if we sold 30 items, we look at the first group of items that we purchased, and they were at $100 a piece. So those 30 items using FIFO cost us $100 each, totaling $3,000. So the cost of the goods that we sold, those 30 items, cost us, according to first in, first out, cost us $3,000. So that would be journalized and that would be posted. And we need In the ledger, a debit to this account, cost of goods sold expense, and we would credit inventory. We should know that by now, leaving us with a debit balance in inventory of $14,700, and that corresponds to what you see on the first page, $14,700. The gross profit then, this would be shown on the income statement. Gross profit is figured by taking a look at all the sales. We only made one. We sold 30 items on the 25th at $150 each, $4,500, and we subtract the cost of the goods sold, the $3,000 we figured using FIFO. When we subtract the $3,000 from the $4,500, the net, or excuse me, not the net, but the gross profit would be $1,500. So sales minus cost of goods sold equals gross profit. On the other hand, if we decided to use last in, first out, these same items, we would look at the group of things that we bought in the very last purchase. The last purchase was the 21st, and those items cost $130 each. So the 30 items that we sold cost us, according to LIFO, $130 each, which means the cost of those goods that we sold will be $3,900. So once again, if we change our numbers to $3,900, we would have debited cost of goods sold expense by $3,900 and credited inventory, leaving us with a balance now, a different amount of money, a different balance, $13,800, which is shown on this page as the ending inventory. Gross profit then, again, would be the sales of $4,500 minus this cost of goods sold, giving us a gross profit of only $600. So you see different amounts of gross profits depending upon the type of valuation method we use. And that's according to GAAP, if you remember, generally accepted accounting principles. Businesses can make a choice, and there are a lot of factors that go into this, but it does indicate a difference, particularly in this particular store. The final method was the average cost, and this is kind of the middle of the road example, particularly between first in and last in methods. If we look at the average cost, we need to figure the average cost of the things that we bought. We bought $17,700 worth of inventory, and that's based on 150 items we purchased. If we divide that, the average cost is $118. So if this sale was for 30 items, if we multiply 30 times the average cost to us of $118, those items cost us $3,540. And again, if we put those amounts in, you see an inventory of $14,160. And that corresponds again to our first sheet, which is showing inventory somewhere between the amount indicated for first in, first out, and the amount indicated for last in, first out. Gross profit then figured the same way, total sales minus the cost of goods sold, in this case $960, someplace in between the first two methods. So again, companies use different methods based on different details in their own business, but I want you to understand how the computations are made. So those are the three. There are other methods, but we just are using those three at this point. So those are things that you have to understand and will be part of the test that you will be having. And I want to show one more thing, and this is relatively new for you. We're not going to have problems based on this, but I want to look at what's considered in determining the cost of goods sold for a manufacturing business. A manufacturing business would be one that actually makes the items. So it's not the dealership that sells the car, but it's the factory that builds the car. So a manufacturing company, that would be a large example of a corporation that manufactures automobiles and trucks and so on. But it could be any number of things. So when we have a manufacturing business, there are three types of information that we need to consider in order to find the cost of goods sold. We need to look first of all at the direct labor needed to manufacture the items. These were the people that actually construct the thing that is eventually going to be sold to a retail store, and the store then marks it up and sells it to customers. But the actual labor needed to manufacture the item is one factor. Now, this does not include the administrators, the president, the marketing people, the secretary, staff. None of that is part of this. This is direct labor. Secondly, we consider the materials. We need to figure out how much those actual materials cost us. Might be metal, could be plastic, could be aluminum, could be any number of things needed to manufacture this item. But that's the second thing that needs to be considered. And the third thing is overhead. Overhead deals with things like electricity, heating, water, etc. Direct things that are needed in the manufacturing process. Usually it's a percentage of the total. So we have electricity bills not only for the factory but also for the administrative offices. So we have to get a percentage of those overhead costs that go into the manufacturing process. So what I want you to know is that there are three things involved in a manufacturing company determining the cost of the goods that they sell. The labor, the direct labor needed to manufacture that item, the direct materials needed to manufacture it, and the overhead needed to manufacture the item. Add those three up, you get cost of goods sold. At this point, there are a few questions that I want you to answer, so go back to your course page and let's do that now.